At its most recent meeting in March, the Federal Reserve delivered what many call a dovish hike, as it broadened its objectives to simultaneously fight a two-pronged attack against persistent pressures from inflation and market instability due to weakness in the financial system. This shift likely signals an inflection point in the global interest rate cycle and will have repercussions for fixed income investors around the world. In our recent note, Income Generator, titled Beyond the Inflection Point, we identify 5 specific factors that fixed income investors should consider as they position their portfolios this year and beyond. Number 1, yield curve normalization. It means after a period of higher rates and flatter curves resulting in an inverted curve, we expect yields to both stabilize, ultimately start to come down. We think curves will eventually start to steepen. It's very difficult to precisely time these shifts and know exactly when these moves are going to occur. But when we look at the market, we see a market that is starting to shift in that direction, and we think it will start to move both lower in terms of yield and steeper in terms of the shape of the curve as we go through the course of this year and into next. Number 2, maximize yield. Income remains the primary driver of returns for a fixed income investor. Yields today are as high as they've been in well over a decade. These are attractive opportunities and entry points for bond investors to both secure current yield for today, but also harbor yield for years to come. We think being able to capture as much yield as possible in portfolios, whether it's governments, corporates, structured, US, international, taxable, tax-exempt, doesn't really matter. We want to maximize income and yield in our portfolios. Number 3, stay up in quality. It's a challenging time for policymakers and the risk of a mistake is high. Growth is slowing, inflation is coming down, and the possibility of a recession is rising. In fact, we're positioned for a material slowdown in growth over the coming quarters, and we suggest you do the same. With the risk of a recession relatively high, high-quality issuers become critical to your portfolio. That doesn't simply mean buy AAA-rated bonds. It does mean looking very closely at the fundamental qualities of both the issuing entity and the security you're invested in to make sure there is a very high probability that you're going to get paid both in full and on time. Number 4, go global. Swapping non-dollar currencies into US dollars is relatively attractive today. Buying bonds denominated in euro, sterling, even yen, bringing those back to US dollars and picking up anywhere from 150 to 200 to even more than 250 basis points is a way to add yield and income to a portfolio, preserve liquidity, and maintain that higher quality bias that we recommend in portfolios. And then lastly, use the municipal bond market for stability. Munis have 2 very strong characteristics. 1, consistent demand for munis means that when rates go up, the demand for municipal bonds also increases. The value of the tax-exempt nature of a bond increases as yields rise. Number 2, the fundamental characteristics of a municipality run somewhat counter or at least off cycle to the typical economic cycle. And so we can find diversification benefits in municipal bonds as we think about incorporating those and comparing them to more typical taxable bonds. So the combination of very strong technicals, durable fundamentals, means the overall volatility structure of munis tends to be relatively low when we're going through this point in the cycle. If you have questions or need additional information, feel free to reach out to me or anyone else on the Allspring team as we work through these both dynamic, challenging, and very exciting markets over the course of this year and beyond.